Everyone is working hard and wants their money also to work harder. Hence, everyone is trying to invest their money either in the money market, fixed income, or equity, or in some kind of investment funds. Currently, we have various structure of investment funds, and out of them, three are predominantly popular, namely mutual funds, hedge fund, and private equity. To give you a high-level understanding of how large they are, so mutual fund is equal to somewhere $78 trillion. Hedge fund, I talked in another video, is $3.6 trillion. And then private equity, that is also around 2.8. So altogether, we are talking about some $84 trillion worth of funds only. And to relate that number, it is $10 trillion bigger than the world's GDP. So world GDP is around $74 trillion, whereas the amount of investment, the asset under investment globally is $84 trillion amongst these three major funds. So hello and welcome. My name is Nidhish Singh. I'm chartered accountant and member of ACCA CISI Institute of Directors. I have worked 16 years in investment banks and worked at the position of vice president, director in banks like JP Morgan, Citibank, SS&C Global, and predominantly I have spent my time in this investment fund, the reporting and the governance. I worked in India and a couple of different countries as well. So today I'm going to explain you the difference between these major funds, their risk and reward profile, how they work, how they evolved. That will be, of course, a high-level discussion, but you'll get at the end idea of how these funds differ, who can invest and who can't, what are the different risk and rewards amongst these funds. So let's start with one of the most controversial and fund structure, which often grabs the eyes of media as well, that is hedge fund. So the hedge funds history is equally interesting. And that start with someone called Alfred Winslow Jones. Few of you might have heard, but he was the person who started the hedge fund saga. So he was born in Melbourne in Australia around 1901, and he graduated from Harvard University. That was one of the topmost then, and still it is one of the most prestigious university in the world. So he graduated in 1923 in political science, and he started his career as a diplomat. And he was working around 1930 in Berlin, Germany, as a diplomat. Interesting job, good life. However, he also completed subsequently, a few years later, a PhD in sociology. And he started to try his hand in writing. So he became editorial staff in Fortune magazine. That was around 1940, early 1940. Time flies, and he started to also write with regard to investment market, money, business. So that grabbed his attention that he should also start managing money. Because while writing, he might have got interested in how the money is managed, or he might have got some ideas. So he raised, at that point of time, around 1942, I think it was around 1945, he developed a pool of $100,000. 40,000 was out of his own pocket, and he raised additional 60,000 to make a handsome pool to invest in the market. What was his idea? His idea was to create a pool of fund and make the investment such that his profit always remains protected. So he wanted to hedge his profitability and the profit whenever market goes through ups and downs. So that was his idea. And his concept was to hold long-term stock positions and also short sell some of the stock. So short sell when he thinks that the stock is going to go down, he will sell at higher price by borrowing and cover later on when the price crashes or goes down. We are seeing that on regular basis in the stock market as well as in the crypto market. That's a separate discussion. We'll cover some other day. So he make a good balance of long short, and that subsequently was called long short strategy. This is one of the 8 to 10 different strategy of the hedge fund. So he used that strategy, and early 1950 he also altered, he tried to play around with the structure, the legal structure or the management of the fund as well. So he altered the structure of the fund by bringing limited partners, means like external investor. So limited partners are external investor into a hedge fund. So he called some limited partners into the fund, and his team was probably general partner. So they formed a partnership, and the structure since then became that 20% incentive fee will be paid to the managing partner or investment managers of the fund if the fund performs well, right? And of course, there's no evidence of the management fee that time, but that definitely incentive fee was being charged around early 1950s. So as a first money manager, he was the one to combine short selling with the long, and his structure was called long short strategy. Hence, this way he is the father of hedge fund. He was the given the credit for forming the hedge fund in the world. So now brings us to the one of the key question, that what hedge fund can do, how it is regulated, and what are the risks and rewards of a typical hedge fund. So when it comes to such fund structure, there are various risks, because as I said earlier, it involves certain leveraging, means borrowing the fund and investing into the market. So leveraging is not always a healthy practice. Plus, it also involves short selling. It also requires, for the purpose of hedging, use of derivative such as options, swaps, future, forwards, which makes the fund inherently and structurally risky for common person or for the mass, right? So regulators, starting with SEC, Security and Exchange Commission in the United States, they formed certain rules as part of investment guidelines 1933 and 1940, that hedge funds cannot advertise to the mass public. Hedge fund will restrict itself to qualified investor or accredited investor in their language. And who are the accredited investors? They are quite rich, relatively wealthy people of the society. For example, as per the SEC rules, those who have $200,000 income every year, or with spouse they have $300,000 income altogether, and they also have $2 million worth of assets and property, excluding their house of residence, they are qualified and accredited investor. Only they can invest into a hedge fund. That too, it cannot exceed 100 investors. In return of that, because they are not the hedge fund managers and hedge fund investment managers actually are not able to advertise these funds to mass, they can be restricted to only selected investor. They are given certain freedom from the compliance and regulations. But that is also nowadays, after various crises in 2007, 2012, the Frank-Dodd Act was incorporated, and Frank-Dodd Act requires hedge funds to follow certain guidelines, especially when the AUM, the asset under management of the hedge fund, is more than $150 million, right? So in this manner, it is kind of a mixed or a moderately regulated fund. Is not fully free from all the regulation, but it's not tightly monitored or regulated like a mutual fund. So that also tells us that generally the mutual fund is the one which is highly regulated, and the reason is mutual fund is advertised to the mass market. People like us, every single person can invest into that. even 100 rupees to 500 rupees or a small dollar amount can be invested into the mutual fund. That means it is the fund of common person, mass market. And that is the reason mutual fund has to follow much more stringent rules as compared to the hedge fund. And that kind of now clarifies the difference between the hedge fund on one hand and the mutual fund. So mutual fund is for the common people. It can be advertised, maybe 100,000 or 1 million or 1 billion people can invest into that, as opposed to the hedge fund. Yes, but mutual fund cannot do massive leveraging. It cannot use exotic derivatives, or with the exception of some future or FX derivative, they cannot use the derivatives as freely as a hedge fund, because derivatives are considered risky. As Warren Buffett said, derivatives are weapon of mass financial destructions. They are considered very risky, and they are, in fact. During 2007-2008 crisis, we saw various CDS were issued against a couple of banks in Italy, and those CDS were blamed for the crash or failure of the banks. So derivatives are quite risky. So hedge funds are permitted, but mutual funds are not. And mutual funds are open-ended. They need to report the daily NAV, and they have to be very, very accurate on daily basis, because people are going to buy and sell regularly based on those investment numbers or the reported P&L or the NAV or the assets. So these are predominantly the differences between hedge fund and mutual funds. Now coming to the fee structure. The fee is in the hedge fund is largely, and even mutual fund, 2%, 1 to 2% as the management fee, which is paid to investment manager, not to exceed the performance level or benchmark, just to manage their fund and pay to their staff, employees, do their research, electricity and admin fees, etc. So the 1 to 2% fees are paid to the management team. And if the performance is really good, then 15 to 20% of the incentive fee or performance fee is also paid, subject to certain terms and conditions. There are clawbacks, there are hurdle rates that also comes in picture. So just to explain what is the hurdle rate here. Suppose that you invest $100 in a post office, or 100 rupees in the post office, you are likely to get 6 to 7% or 8% return annually. So why would you invest in any mutual fund or hedge fund if you have to pay incentive fee for the entire profit, right? So since hedge fund or mutual fund are riskier than a simple plain vanilla investment into the government bonds or post office, the hurdle rate is set so that to the extent of 8%, you don't have to pay any incentive fee. For investment manager to get incentive fee, for investment manager to earn and deserve the performance fee, the fund has to exceed that hurdle rate. Only when the fund goes above that hurdle rate, the incentive fee and performance fee will be payable to the investment manager. Otherwise, earning up to the 8% or 7% is considered like a bare minimum, because that much can be earned even from the post office or the government bonds. So that's why hurdle rate is set so that performance has to go above that in order to get incentive fee. Now, there are various other nuances called clawbacks and IRR, various other factors also considered. Then there's a scope for adjustment and reversal of the incentive fee. There is a crystallization. We'll talk about those in some other videos when I will go into the details of the fund accounting training. But that is a high-level understanding of the fee calculation and the criteria of the incentive fee to the investment manager, the guy or the person who is day-to-day making the investment decisions and monitoring the performance of the fund. Now, it brings us to the third structure of the fund, which is private equity. Private equity is, as the name suggests, is a stock, it is an equity, but it is not on the exchange. It is privately held. So I might start a some startup based on some very nice technological idea, and I want to raise fund. So I have to give someone the ownership of 10 to 25% or 50% to get a couple of $1 million in my project, in my company. So this is a private transaction between me and my angel investor or my friend who is willing to start in my venture. So this is a private transaction. It is a private equity, and hence the name. Now, the difference between the private equity and the hedge fund and mutual fund is that hedge fund and mutual funds deal with the public stock and equities and derivative, whereas the private equity deals with all the privately held assets, projects, startup, businesses, etc. And amongst the private equity investor, there are also various categories, which we will talk about in a minute. But they have inherently a different type of inclination. Even private equity have different types of strategies, just like hedge fund we talked about. But that will be for another session. The investment business is a massive one, and we have to talk about all of them one by one in different videos. Stay tuned to that, and don't forget to like and subscribe the channel. Subscribe the channel so that you get regular videos and update from my channel, and also share amongst your friends and others, so that everyone understand the basics of the investment business and some of the key updates from the market. So coming back to the structure and the way private equity operates. So generally, one fine morning, I have a good idea. I want someone to give me money, 1 million. I will make a proposal and a plan that how the money will be raised and where I will be investing, how it will be generating revenue. In 2 to 5 years down the line, I will make a project plan and will give to investor. They will approve it and they will make the investment. After that, 2-3 years, the fund will not be, or the startup might not be earning any revenue. It will just be getting all the cash from my investor, and my project will survive and expand. And I expect that 2-3 years, 4 years down the line, it will start to generate some money and the cash. So to give some interesting insight about private equity, we all know, if we check our app, mobile, we know what are the different tools that we use frequently. What are they? Google, WhatsApp. I think some of you might be checking WhatsApp right now. Google, WhatsApp, Instagram, Facebook. How can you forget Facebook? Or in India, Zomato. In China, Alibaba. And Zoom, all the calls that is taking place. All these technological giants and great products were once upon a time invested by the fund that we are talking about, private equity. So private equity had invested in all these nice startup and the technological ventures and ideas some 10, 20, or 30 years ago, because Google started around 1996, 97. So all these companies, sorry, it was around 1992. It had grown in size by 1996. So all this company and startup actually are the product of private equity supports. So generally, once the fund invest and the company start to grow, the private equity aims to come out of that after 7 to 8 years. And there is a complete structure. So private equity firm will make the commitment that, okay, we want to, or the LPs of the private equity fund will make the commitment to the investment manager that whenever you need maybe 10, 20, $50 million from me, from us, we'll give you. So that commitment is called commitment money. And then when the cash is required by the investment manager of the private equity firm to say invest in Zomato, to say invest in Instagram or your own firm, then that capital will be called. So investment manager one fine morning will call the LPs, limited partners, saying that, hey, you had promised $50 million and you need to give us that capital to invest in one of the nice startup, which Nidhish or someone else has started. So that capital will be given in around 20 to 25 days to the fund to invest into the startup, and that process is called capital call. So that is the difference between the commitment. When the limited partner promises, it is called commitment amount. When the investment manager asks for that capital to invest into the startup, or here startup is like equity, right? Just the difference is that it is not in the public market, but it is a private market. So investment manager has to invest into the startup and have to call the capital. This way, once company or the investment survives, start to make money, then investment manager will aim to exit from that in 7 to 12 years time, or it will sell it to another private equity firm. And there are varieties of different private equity firms or private equity strategy which enters and exit from the private equity business or private businesses. So we will see that in a picture soon. So let me share the screen. Now you can see this. So here what is happening is, as we discussed a minute ago, first the private equity firm has to advertise and get the investors, LPs, limited partners. So they will make the commitment, as I said, say for $50 million. That commitment amount will be drawn in different years, say in 5 years time, and gradually invested into the startups. So by end of 3 to 5 years, all the money would be called and the startup would have got the money by the investment manager, the private equity firm. Then in 5 years time, we expect that startup will start to give the result. Often it also fails. I'm not saying that all the startup just prosper and give the money. Most of the cases, the startup fails after 3 years, but many of them survives as well, and they give good returns as well. So from 5 to 10 years or 5 to 7, 8 years, the startup continues to grow, upward movement. And at that point of time, private equity firms will continue to support the startup, providing the management, the idea, the network, the connections, and all their skill set, so that it continues to grow. Faster it goes, the better for the private equity. And around 8 to 12 years time, between 8 to 12 years, the private equity firm, these people, will try to exit, because the firm is performing well. And if the private equity would have totally in total invested 500 million, because don't forget, just like this investor, there could have been 5-10 different investors who would have altogether invested, say, $500 million into the startup. And now the private equity managers think that, okay, if we go public or we sell this startup to another venture capital or another private equity firm, we can easily sell it for, say, $3 billion. We know what is happening nowadays with Baiju, etc. And Cafe Coffee Day was also one of the prime example of the private equity investment, and that caused a lot of pressure also on the CEO, which caused him a lot of mental stress and pressure as well. So back to the story. So 500 million could become $3 billion 6 times, and investment managers will think that, okay, after 8 to 12 years, they will be able to exit at 6x, which will be massive profit, 500% profit, right? So around 12 to 15 years, all the private equity businesses will exiting from the company which was founded and invested by them. So that is the way the private equity firm and their investment cycle works. Let's see how the investment itself, the firm which is invested by the private equity itself look. So that is in the second page. Life cycle stages of private equity firm. So y-axis shows us the cash flow, and x-axis shows the different stages. So I just said earlier, the first 2-3 years, or it could be 4 years, there's no hard and fast rule, but the first 2 to 4 years, private equity firm just keep investing and pushing and pumping a lot of money into the startup. And at that point of time, it will be just investment and expenses. There's no money, there's no profit, there's no revenue from the startup to the private equity or the LPs, limited partners. So how does that look like? It looks like this. It's called J curve. See, it looks like a J. My handwriting is not the best, but anyway. See, let me remove this. So this looks like a J, right? So that's why it is called J curve. And what is this bowl? This bowl is called blood bowl. The reason is that it is always red because it indicates only expenses. It indicates only the losses for first few years. Before the firm start to break even, means when the expenses and the revenue is equal, that point of time, until that point of time, there's only loss, there's only expenses, and the private equity and the limited partners have to only push money to allow the firm to survive. The firm must be fighting for survival at that point of time, first 2 to 4 years. Those who have seen the startup working, or if someone has tried earlier, would understand what I'm talking about. So this trial stage and the initial stage is that then firms start to make revenue and break even. And at that point of time, this investor might exit at some X, maybe 1 or 2X, it will try to exit. Typically, those who invest money into your idea, they are called angel investor. And once the company or startup survive, they will sell it to some bigger banks or venture capital firm or private equity firm, and they will exit. From there onward, during that period, there will be venture capital company or private equity company coming into this, and they will raise either they will invest their own money, or they will also raise a lot of debt from the market in order to buy the firm, because remember, the firm has survived, so it would have become expensive. So the private equity firm will raise the money from market, will pool their own money, and will make some big transactions to buy the company or take the controlling stake. Again, at this stage, the company has not only survived, it has started to create more and more customer base, new product or new market. It is trying to expand across the country, and it is well known now. So at this point of time, it would have become well known, and then again, venture capitalist might sell it to some other big private equity company. At that point of time, the company can think of going global, or maybe if it is not national already, it will try to expand its network, supply chain, and become a dominant player in the country. Subsequently, the private equity firm will try to bring the firm into IPO. See this? Initial public offering. And there it will make massive money once the share goes into IPO. So this is where this is the cutoff point of the private equity investment. After selling it to IPO, after bringing the entire firm from nationalization or a big firm into the IPO, the private equity firms will see the end of its role. It will wash off its hands with 3 to 4 or 5x return and will exit. So that is the life cycle in the stages of the private equity firm, and it's a startup. And this is the overall idea of how they work. They get an incentive fee called carry. They don't get a performance fee like a private equity, like a hedge fund or mutual fund. They get, in fact, something called carry, and it follows a waterfall methodology plus the hurdle rate, both. And that is again a detailed calculation. It's not complicated, but yes, it is complex. It depends on the private placement memorandum and LLP documents, etc., how it is calculated. So again, that's a matter of massive long training. We will discuss about those later. I hope with this video you got the idea of hedge fund, private equity, and mutual fund, what they are, what are the risks and rewards, and also how they work, what is their fees structure, etc. So continue to encourage people to subscribe to the channel. You also subscribe, and quite importantly, if you want to use these and revise to acquaint yourself with the fund structure, and also it can help you to prepare for your work or interviews, etc. In addition to this, I also get a lot of demand for detailed training of different funds, how the legal documents are interpreted and prepared, how valuation is done, how pricing is performed, what are the different nuances in calculation of fees, how different technology works. So I'm going to soon launch next batch of courses for hedge fund as well as the private equity, and we'll keep you all posted. You can, if you want to further enhance your knowledge and develop the expertise in this field, you can join the courses, and watch out the announcement on finsapien.com and LinkedIn, etc. So hope you liked it, and if you have any question, feel free to put down your question in the YouTube channel in the comment section, and I will definitely respond to you. Thank you so much. Happy learning. Take care.